Today we are diving into one of the most interesting growth stories in the stock market right now, 2025, because many YouTubers surprisingly are not talking about this particular company because they are jumping in and looking in for views only and therefore talking about some interesting stocks or more popular stocks like Nvidia, Palantir, Alphabet, Amazon. Now, without a doubt, those companies are amazing, yeah? But what we are looking into are companies which can double or which can 3x from here. And one of these companies is Kava. Yes, Kava stock. Now, if you follow the restaurant industry, Kava has been called the next Chipotle. But after its recent earnings, many investors are still wondering, is it still a high growth stock or is it just overhyped? In this video, I'll break down exactly what Kava does, its year-over-year growth story, and we will also discuss its recently quarterly earnings and performance. And then both bullish and the bearish cases. We will also cover the overall stock environment, the current market trends, consumer trends, competitors like Chipotle and Sweetgreen, and end with a realistic Kava stock price prediction. So stick around guys until the end, because whether you're focusing on high growth stocks, restaurant stocks, or just smart investing in the year 2025 and beyond, this analysis will help you discover where Kava stock price could be heading next, and therefore to make an informed decision whether it's a good buy for you guys or not. This is not any kind of a financial advice but purely educational based and will help you guys to make your own informed decision. So without further ado, let's get right into it. Hey guys, welcome back to my channel. Once again, this is your friend Abhishek, but not a financial advisor, and today, like we discussed, we are going to talk about Kava stock. Now, without wasting your time, let's just jump right into the content. Now, the time of recording this video, Kava Group, ticker symbol CAVA, is trading at $58.76, which is down by 6% on 29th of September. So I'm recording this video on 30th of September, which is Tuesday, and hopefully I'll be able to release this video in this week, but nevertheless, the stock is trading at $58.76 with a P ratio of 53. Now, let's get into a detailed analysis. So I have made this amazing presentation for you guys to help you understand the basics of Kava, and then we will dig deeper into the company and we will do our stock analysis for Kava. So you guys will become a better investor after this video. Okay guys, so here we are on Kava Group stock analysis, and the juicy part of this video starts now. So now, this is for those who have no idea what Kava actually does, because I'm pretty sure that many of my viewers or many of the viewers out there who are new to this channel might not have any idea what Kava is actually doing, let alone investing into Kava. So what Kava does is, Kava is a fast casual restaurant chain, primarily in the US, focused on Mediterranean cuisine. Example, customizable bowls, spreads, pita, protein, grains, vegetarian, etc. Also sells Mediterranean dips, spreads, dressing via grocery channels. All restaurants are company owned, that is not franchised. It's important, which means Kava controls operations more directly, but also bears all the cost. Yeah. Founded as Kava Mess, acquired Zoe's Kitchen in 2018 and has absorbed those locations, many rebranded to grow the presence. So as you can see on the right side of this slide, so they have the digital pickup everywhere, yeah, and they have this multi-channel format meeting guests wherever they are. Drive-through pickup, catering, digital kitchens, hybrid kitchens, and CPG production facilities. So these are all the services which they provide. Now, let's talk about the recent year and year-over-year growth, which we discussed in the agenda of this video. So the performance is what you see from the numbers on this slide. You can pause the video right now and just check the numbers yourself, but we will just summarize them now. So metric revenue growth in the quarter 2025 was $278 million, which was 20% year-over-year growth, yeah, from the same year in 2024. Same restaurant sales grew only by 2.1%. Now this metric is quite important and we will dig deeper into that, why it's important. And it's also used for our valuation, yeah. So much lower, as you can see, these are the notes, much lower than earlier comps. Traffic basically flat, growth mostly from menu price and mix. So they have been mixing actually their menu prices more in the higher range. So they are moving towards the higher range just to compensate with the margins and the revenue, so sales. That's why it's not good of a, let's say, strategy, but they have been changing this strategy, and we will get onto that in a moment as well. So new restaurants opening, 16 net new in quarter 2, total 398 restaurants, not that bad, which is a 16% year-over-year growth, almost 70% in total locations. Restaurant level profit margin is quite decent, 26.3%, which I do understand that in the restaurant business this is quite decent, to be honest, which is slight down actually from the prior year, yeah. And because of the same reasons, increasing cost and their new steak launch, which resulted in increase in cost, yeah. And then digital revenue mix is 37.3%. A large share of sales comes from digital ordering, which we can see actually the value is quite good in double digits and 37.3%. And net income was $18.4 million and adjusted EBITDA was $42.1 million. Now increased versus the same period, and it's increased by 22.6%. So EBITDA increased by almost 23%, which is quite impressive, though it's slightly down versus the same period, but still staying in these double digits and above 20% is quite impressive, to be honest. So here is the recap of everything. So you can see Kava revenue $278 million. Kava same restaurant sales growth was 2.1% compared to the averages, and 3 years same restaurant sales is around 34.7%, yeah. But this is the total annual, yeah. And Kava restaurant level profit margin 26.3 million, adjusted EBITDA 42.1 million, net income 18 million, and free cash flow $21.9 million. Not that bad. Now, why the revenue dropped? So we saw that the revenue actually dropped, okay? So now on this picture, as you can see, the quarter-over-quarter revenue is dropping, yeah, so $328 million to $278 million. The rest, as we can see, same result sales growth also dropped, and we can also see the same restaurant sales growth, it dropped to 2.1% from 10.8 to 2.1%. This is quite a drastic drop. Now let's talk about why this is happening, why the revenue has dropped. So it shouldn't be just pink glasses and butterflies. This is the purpose of this channel, to show you guys both scenarios so that then only you can make an informed decision. So same restaurant sales growth slowed down. This is one of the reasons for the revenue slowdown, because these are interrelated, directly proportional, of course, yeah. Kava reported same restaurants comparable sales growth of 2.1% in the Q2 year-over-year, which is much lower than what many investors expected to be at 6% approximately. Nowhere near 6%, and much lower than the prior momentum, which you can see 14.4% in quarter 2 2024, 18.1% quarter 3 2024, then straight jump to 21% in the quarter 4 2024, then decline 10.8, and now in single digits, low single digits. That's huge. That's a huge drop. So Kava had to rely more on charging more or shifting customers to a higher priced item, like I discussed before, that this was not a good strategy, and this actually doesn't help Kava for customer retention, because if you're increasing your menu prices, then of course you're losing customers. That's simple. That's what actually PayPal was doing as well, yeah. But I think they're changing that, and like I said, we will come on to that in a moment. So this is what they did now to compensate with the slower same restaurant sales growth. So they increase the prices. Not a good strategy, but this is what they had to do. They are running a business, so if nothing works, then this actually should have worked, and we see that it did work and it helped the margins. So macro consumer based behavior uncertainty. So this is of course a normal, I would say, statement from every management when their quarterly earnings are not that great. I don't believe in that, but anyways, management described the consumer environment has been in a fog, meaning uncertainty, consumers pulling back in discretionary spending, more cautious behavior. With the interest rates going down, this might change, but we are not that sure, because US is in a really different situation, macroeconomic situation. So there is recession, and it's like a closed loop now. There is recession, the interest rates might go down, yeah, it will go down, but still the jobs are not there, so it creates more recession. So there is less spending because there are no jobs. So this reducing the interest rates might even cause inflation, but on the other hand, people are still not spending. So it's a bit tricky situation there. So I'm not that sure if this discretionary spending will increase in the coming quarters, but let's see. So earnings preview, what to do and what to watch next. So earnings preview, what to watch next, okay? Whether same restaurant sales grow can accelerate back again. The current low digit is 2 to 3% and getting closer to guided 4 to 6%. By the way, the management said that they are going to reach 4 to 6%. This is the guidance. Let's see if they can make it. How traffic versus pricing mix contributes. So I hope this doesn't happen, that they keep on increasing the price, but they have the management said they won't be doing this, and we will see that in a moment. Currently traffic seems flat or weak, with price mix doing the heavy lifting. So like I said, that's doing the heavy lifting. If traffic weakens further, comparable could get tougher. Okay. Margin pressures, of course there are margin pressures because input cost, inflation, food, labor and everything, and they introduced this new stake, so that also put a lot of pressure on the marketing costs and operating costs. So that's of course a lot. And pre-opening costs for new stores, wage costs possibly rising, lease, utility capex. Leasing is always a pain in the ass, but anyways. Digital mix and its margin impact. Delivery tends to cost more, but so they have to find a way. If digital convenience is better, of course, but does that affect the margins in a positive way? So this is what they have to find out, okay? This is what we as investors also have to see. How well the new restaurants are performing. This is what we also have to see. The average unit volumes are expected to hit above $3 million for new stores, new restaurants class forecasted. So this is what they have forecasted, that the AUV will hit $3 million, and we have to check it out if that will actually happen. Free cash flow and how much capital is needed to fund growth. This is a capital intensive business, as we know, but how much they would be spending more on the capital. So this is what we as investors have to watch next to see how their future and fundamentals will play. Okay, so now we are on the bearish case scenario, and this is the purpose of this video. So there should be one bearish case scenario and a bullish case scenario, and we have to discuss both of the scenarios to see which way is more, and according to that we should make our decision, because that decides our risk to reward ratio. So bearish case scenario, why investors are worried. So first point, slowing growth in existing stores, like we already saw. Okay, same store sales, the sales from restaurants open at least a year only grew by 2.1% last year. Like I said, this is quite an important point. That's a big drop compared to earlier strong growth. Worse, most of the increase came from raising menu prices, like I said, not more customers walking in. Second, high cost. Kava is facing high cost for ingredients, especially steak and proteins. So they introduced the new steak, and that is causing a lot. And therefore they already increased the prices on all other products. So now also increasing the price on the new product is actually might be not that beneficial for the business. So they are in deep black waters right now. And of course labor and rent also cost. If these costs keep rising, then they can't raise the prices further, because there is only a limit up to which they can raise the prices to attract customers, and then the profits might shrink. Yeah. Now expansion risks. Opening new restaurants is expensive, like we saw. If new locations don't perform well, then where do they get the money from? Okay, they don't want to get unprofitable back again. They just got profitable, and that's important for restaurant businesses. Competition is high and it's tough. Kava competes with Chipotle, Sweet Green, Shake Shack, and other fast casual brands. If others expand faster or attract more customers, Kava's growth could slow down. 5. High valuation and expectations. So like we discussed, P ratio is at 52, but does that metric decide the valuation alone? In my opinion, no, and we will get on to that. But still, Kava is not that cheap as well, especially after the current earnings. So Kava stock is already trading at a higher price compared to its current earnings, so much higher P ratio, like I mentioned. Then why I'm mentioning this, because many of the investors could see this as the first point of view, and then they see if it's too high, then maybe they won't even go deep into the stock. So that does make sense, and that's why I have put this metric as the valuation metric for those that if you are seeing PE ratio as the only metric, then maybe that's not a way, not a proper way to make your judgment regarding your investment into that particular company. But I will prove that, okay? That means investors are expecting big growth. True, if results are just okay, instead of amazing, this stock could sharply drop. And we know that. Now, bullish case scenario. So of course there's a bullish case scenario for this company, because that's why I'm mentioning this company. Otherwise I wouldn't be mentioning this company if it was just waste of your time, my time, and my analysis. So now, big growth ahead. Yes, Kava does have a big growth potential. Kava has approximately 400 restaurants today, but wants to grow to 1,000 restaurants plus by 2032. and they do have a plan for that. So that means they plan to more than double their size in less than a decade. If each new restaurant performs well as existing ones, then that's a lot of more profit and revenue and sales. The second point, strong customer demand for healthy food. So customers, as we know, are getting more health conscious, and they're moving towards healthier, flavorful quick meals. They do want to have cheat meals, but not that dirty cheat meals. So that's where Kava comes in. So Kava's Mediterranean bowls and pitas fit that trend. Many investors compare it to the Chipotle's early growth days, and that's a big statement, guys, being the healthy fast casual option. Okay, so if a brand is being compared to a brand which has performed amazing and which has performed which is considered as an evergreen stock in that particular niche, then you can see that this company is doing something right. Okay, solid profit margins. Even while growing fast, Kava has restaurant level profit margins around 25 to 26%. This is what I said previously in the video, earlier in this video, that these margins and these numbers, these metrics are quite amazing, which is strong for the restaurant industry. And that's true because they're capital intensive businesses. This shows that they are not just growing, but growing profitably. And that's important. Now, digital sales power. About 37% of Kava's sales come from digital orders, pickup app delivery, which is quite better and has better margins. This is important because digital sales often bring repeat customers and bigger orders. Analyst support. Big banks like Bank of America put out a bullish report saying Kava could reach $110 plus, so double from here, and possibly open more than 1,000 restaurants. Wall Street optimism can fuel stock momentum, but this is temporary. Okay, these price targets I've just put in to show you guys that even the Wall Street analysts think that this stock can more than double. But that's not the purpose of this video, to lure you guys or to make you invest in such a company because some analyst said so. Okay, because analysts are seeing the coming 12-month period and that's how they decide, but we are investing for more than a year. Yeah, we need to give them time. We need to give them some time to see quarter-over-quarter results. Of course, if it keeps going down within 2 quarters, then maybe it's not that good of an investment, but let's see. So this point was just to prove that don't just go in for the analyst reports. In short term, maybe these price targets will help Kava to go higher, but in long term, we don't care about that. But of course, if it reaches $110 and if it's double already, then maybe yes, of course, that's what we wanted and we will come out of the company. Now, this slide is quite important, and this is a mix of bullish and bearish cases. So Kava has recently updated their guidance, and it's not all good but not all bad as well. So the first is new restaurant openings. They have increased it, but same restaurant sales growth, they have now said that they will be doing only 4 to 6% instead of 6 to 8%, which is a reduction. Restaurant level profit margin, they have stayed the same. They said, okay, we will reach this. Pre-operating cost has increased, yeah, and adjusted EBITDA has stayed the same. So there are 2 bearish points, but rest is staying the same, and 1 is a bullish point. So just for you guys to see that where they are heading, I would say even if they stay at 4 to 6%, which is a growth from 2 to which is double than what they did just this quarter, 2.1%, I would be happy, to be honest. Yeah, really. So now there are some recent news and catalysts, because this is quite important as well for short-term investors, but also for long-term investors. So now, like I said, Bank of America rose the price target, which is a catalyst, of course. Yeah, but it didn't work until now. But who knows, maybe in the coming 5 to 6 months, it might. We never know. Okay. Menu and product innovation, rollout of stake options, side items, digital promotions, loyalty program enhancement. These could help increase traffic and average check. And I agree. Expansion into new markets, example, entering states like Michigan, first location in Canton, etc. And this expansion might help because it has helped many other restaurant businesses as well. This is what they have to do. They have to expand. And they are not losing money. They are profitable. So they can take this risk, okay, to see and test waters. No price increase planned for 2025. Like I said, the management said, okay. So then they said, okay, we have done enough. Now we will not increase the prices anymore. And this was a good decision from the management, I would say. Now, upside from loyalty and brand strength. If loyalty program reworks, generate more frequent visits, that improves retention and comps. Normal stuff. Real estate growth and unit economics. As newer stores reach AUV more than $3 million, that helps to justify the expansion. And I know I should not compare this with McDonald's, but as you know, McDonald's earn more money from their real estate than their fast food business. Actually, as you know, that McDonald's is more of a real estate business. So opening new stores and increasing the AUV might not a bad idea, really. Okay, so competitor analysis, because this is important that you know what the competition is. And here we are. So I have done this competitor analysis for you. So I'm taking 3-4 competitors here just to see what are their strengths, weaknesses, and where Kava has a strength. Okay, Chipotle Mexican Grill, I had to take this into account. And strong brand, high scales, deep financial resources, these are the strengths versus Kava. So this is the strength of Chipotle. And of course, they have a strong cash flow and track record, very efficient operations. But where's the weakness and where Kava can challenge them is less healthy Mediterranean focus, higher price Tex-Mex cuisine, not Mediterranean niche, possibly saturation in some regions, comp store growth more mature. Now, why I'm focusing on Mediterranean and why I have taken this as a key factor from Kava to challenge Chipotle's business, and we will get on to that. The Mediterranean cuisine business is not that small, so don't underestimate this niche from Kava. Sweet Green, also in healthy, fast casual, strong brand loyalty among younger consumers, emphasis on tech, digital ordering, premium price possible. Sweet Green often has higher operating costs, so this is where Kava has the advantage. Slower expansion, competitive pressure on margin. So of course, Sweet Green is not that profitable as compared to Kava as well. Now, Shake Shack and Wingstop, these are chains with strong brand recognition, expanding footprint, multiple competitor brands make it a competitive space. And yes, but Kava has an advantage over them as well. Where? Here. Not all of them focus on the Mediterranean niche. Like I said, their cuisine proposition differs some way and have superior locations or real estate advantage. So Kava has a really good real estate advantage in this case. Now, of course, if in case they have to sell some of their real estate, there is a disadvantage as well. If the real estate market is not that promising, then they might have to sell their assets at a lower cost, at a loss as well. So there is a chance where this could be a disadvantage for Kava as well. But we have not reached that stage. They are still a profitable business. So hopefully we wouldn't have to reach at that stage. Anyways, now, like I said, Mediterranean cuisine is not a small niche. It has a good TAM. So we can see it here. Mediterranean food is still under-penetrated. Yes, compared to Mexican Chipotle or Asian inspired bowls, analysts estimates that Mediterranean fast casual grow into $10 to $15 billion opportunity in the US, in just the US over the next decade. Today, Kava is the clear category leader, and no other national Mediterranean chain has its scale that gives Kava the first mover advantage. And here's the moat for Kava. Now, moat is a factor which is sometimes overvalued as well, okay? And sometimes it's underestimated as well. So there's a balance. There should be a balance maintained when you're valuing a company. Don't just think about the moat, because there are many competitors in every industry. So not every company can have the best moat, but they can still acquire market share. So here they do have a clear first mover advantage and might have a moat, but let's not overvalue this particular moat thing, okay? So Kava's potential share of the market. So Kava currently does $1.1 billion in annual revenue with 400 restaurants approximately. Chipotle, by comparison, has 3,500 restaurants and generates $10+ billion annually. So you can see where I'm going with this now, with all this data. This is to help you explain, what Kava can do, how Kava can perform, and I'm giving you all the numbers, and this is an in-depth analysis for this particular company, for this particular stock, so that you guys can really make an informed decision. I hope you guys are liking this video, and please give it a thumbs up, okay? So if Kava hits its goal of 1,000 restaurants by 2032, which JP Morgan said that they might be able to reach, and this is what the management also said, and keeps the average unit volume around 2 to 3 million per store, it could reach 2.5 to 3 billion dollars plus sales annually. That is doubling up from here. That would give it around 3 to 4% of the fast casual market, a comfortable, achievable target without needing to dominate the entire sector. Makes sense? This was a bit of a napkin paper math, so I thought that I made these calculations. And so this is why I am telling you guys this, that they don't have to acquire a big chunk of the market. Even with a small chunk of market, they can still grow. And what we care about is the stock price, right? Our capital should grow with this particular business. And my particular aim is to double my money. That's it. Double it. Almost double it every year. And with this particular company, maybe I will be able to do that. Let's see that. Okay. Now that's why we are talking about valuation and price prediction scenario. So here is the juicy part. So data points. First, we need to talk about the data points. Okay. Recent revenue, trailing 12-month period, $1 billion approximately. Net income, $18.4 million. EBITDA, 42.1. Q2 guidance, $152 to $159 million, not that bad. Number of restaurants, 398 approximately, and planning to grow by 1,000 until 2032. Now, these are the data points, these are the facts. Now, based on these data points, we'll make some assumptions. And based on these assumptions will be our valuation model. So, if full year net income grows to $70 to $80 million, assuming Q2 was $18 to $20 million, other quarters similar or improving EPS level, let's keep it modest, okay? Multiples in fast casual restaurants are very high, as we already saw. It's trading at a PE of 50. So some peers trade at a PE of 30 and some 60 depending on the growth expectations. We see that Kawa is trading at 50 to 55 or even 60 and Chipotle at 34. So this gives us our bear case, base case and bullish case price predictions. Interesting, right? Yes, I know. So some key assumptions for bear case: same store comps remain low, 2 to 4%, like is happening, yeah. And growth slows down, expansion slows down, and multiple contractions 30 or 40 price to earnings. So because now they are trading at 50 to 60, even when this 2 to 4% sales growth, same restaurant sales growth was around 2 to 4%, they are still trading at 50 to 60, so I'm still reducing it to 30, okay? And that gives us a price target of $40 to $60, not an impressive at all. So no chance we are getting into that based on the bear case scenario. Now base case scenario, that they grow up to 4 to 6%. Same restaurant sales growth goes to 4 to 6%, which they are projecting, and we see that this could happen. Like they were growing at 20%, 30%, 14% in double digits. So 4 to 6% maybe, hopefully will happen, and we are not going too optimistic. This is what the management said, yeah. So new stores per year 65 to 70, margins 25%, which they can achieve. We saw they are achieving right now. Incremental improvements, multiple 50 to 60. So now I'm taking the multiple 50 to 60 when they can implement what they are just saying, okay. So this could give us a price target of $80 to $110 based on the EPS, yeah. And this means that our stock price is doubled on the base case scenario alone. Base case scenario alone. Now let's come to the bullish case, which honestly, if you take my opinion, I'm thinking it might not happen even. But we have to consider if everything goes well and we take a multiple of 70 to 80, we can reach with 120 to 140 plus dollar target. So that can happen if everything goes really well, if they are back into the double digits for the same restaurant sales growth, and their margins expand, so the multiples will also expand, and therefore our price will reach that particular value. So 3x from here almost, okay. So now this is one valuation model based on the EPS and the price to earnings multiple. Now here comes the second valuation model, which matches our base case scenario. So if I take the EBITDA into consideration and 5 years into future, and a metric growth of 20%, which is lower than the 28%, which was the average for the last 5 years. And now I'm taking dilution 1.2%, which is the average for the last 5 years. I hope when they improve, they will buy back some shares. I'm not in a hurry, okay? I'm not in a hurry that they do some more buybacks. Even if they dilute us a bit more, 1.3, 1.4%, I'm okay with that for the few quarters, yeah? I'm okay with that. Now, price ratio 50, like we discussed, so they are still trading at 52 even if the sales is declining, and the margins were okay, but still the same restaurant sales growth declined to the lowest level, all-time lowest levels, and still they are trading at 50. So I'm still being a bit conservative, that I'm still taking 50 when they come back to 5 to 6% or even higher single digits. And of course I need a minimum return of 10%, so my discount rate is 10%, so this is my margin of safety, and I reach a price target of $124. So the stock price here shows $65, but it's a $58 right now, and that means a compound annual growth rate of over 14% and a fair value of $77. So that is not that bad, guys. That is really not that bad. And this is where this video comes to an end. Yeah, so I really hope that you guys like this video, and this is all about this particular company, Kawa stock. And if you guys would like to watch another video which is same in-depth analysis for none other than PayPal stock, then you can have a look at this video here, right here, and you will find me there. I will see you in the next one, guys. Until then, stay safe, stay healthy, and ciao.